Hello and welcome to the latest Wealth Advice market update filmed on the 4th of June. Today we're going to look at the market performance of May, and for all our viewers, they'll know that from a previous market update we've had Donald Trump causing market volatility. You'll be pleased to know that May has been a positive month in general for the markets as that volatility has started to calm down, with sort of agreements being made and that pause being reflected in the markets. When we talk to clients locally, we've got a lot of people who've retired from Caterpillar, and when we were looking at that share price, it was interesting that with the volatility and the worst point in the market this year from Trump, that share price was down 35%. When I looked at that share price today, actually year to date, it's only down 4%. So that shows, one, how the volatility of the market can come on and come off quickly, and also the importance of staying invested for the long term. Caterpillar, of course, is a US company sending goods all around the world. So certainly we're caught up in the storm that Trump created with the tariffs and the global volatility there. So market performance this month, when we look at market indices and the performance in the start of 2025, we've seen, as we've shown in previous videos, how markets were sort of going along as normal in the early months, and then we see that particular volatility caused by Trump there. People will be reassured to see that on the right hand side of this chart we've seen these asset classes coming back, and if you see at the top there, we've got the European index and we've got the FTSE 100, the blue indices. The green indices at the bottom, that's the S&P 500 that again was most impacted by Donald Trump's trade wars, but actually you can see even that indices has come back quite nicely towards the end of that chart and through May. And when we zoom out and look over a year, again we see that FTSE 100 in blue at the bottom, that we know over previous periods that's been lagging behind the US when they were particularly driving forward with market growth. So we can see there was that transition with Trump and the volatility, but equally at the back end of this chart now we've seen the positive returns. When we zoom out to the long-term period, and when we're talking to clients, investing is typically for a 5-year period plus. When we look at these three equity indices, we can see that the US, the world index, and the UK have all driven those positive returns over the long term, and that is why people with pensions, investments want to be invested for the long term, and they can see returns there in excess of cash. So when we jump into the nitty-gritty and look at what happened particularly in May, as I've already mentioned, markets continued to recover, and that was building from April's lows. We've seen in May consumer sentiment has improved dramatically as this trade tensions have eased, and this has led to one of the biggest monthly gains in US consumer confidence in over 4 years, and that's all down to US-China agreeing to temporarily remove those high tariffs when they're negotiating a deal. So therefore, consumer confidence gives people the ability to say, I'm not going to hold off on any purchases. I'm confident to commit to those purchases, which again helps the economy to move with that snowball effect. So that led to US stocks outperforming most of their global peers, and smaller companies had that rebound of around 5.9%, which was boosted by optimism from the proposals from Trump. His idea of big, beautiful bill would support smaller businesses. So again, we'll see how that comes through in the next few months and how the trade deals proposed with Trump and other countries actually come into fruition. So the S&P 500, which we've talked about a lot with these market updates, that grew by 6.3% in May amid a broader, rally based on, Trump's tariffs, as we've talked about many times. This rally extended into cyclical stocks such as industrials and consumer discretionary spending. So we saw that trickle down effect with those returns. The strong market performance was underpinned by the actual fundamentals of lots of companies. So we saw positive first quarter earning results. 77% of the S&P 500, the companies reported positive earnings, and 63% of these companies reported exceeding their revenue expectations. So that was very positive, that the fundamentals of those companies was positive. When we look at European equities, they also performed strongly and then were up 4.9% as progress was made with those US trade tariff negotiations, and the EU, fears there were starting to reduce the idea that there might be a global recession which had impacted share prices across the world. The UK was the weakest major performing stock market in the month, despite the market going up by 4.1%. And again, this was just impacted by how well other markets had done, and also, the idea that sectors such as the pharmaceuticals were still thinking what's going to happen with Trump's, drug pricing reforms and other elements that are being negotiated as part of the tariffs. In the US, there was rising fiscal concerns, and we saw Moody's, who's one of the big graders for investment grade debt. They were looking at the US and they downgraded the US government. And we saw this impact bond markets and the debt markets with negative returns in May. The Bloomberg Global Bond Index fell by 0.4%, so that was only a small impact, but again, it's interesting to see how the US is viewed globally. It's obviously a very strong country still, but the fact that they were downgraded was almost that shot across the bow to say to Trump, what are you doing with the country? And you want to ensure that this isn't a long-term impact that is going to undermine the value of the US. Bond markets did recover towards the end of the month as the ease in trade tensions reduced, and we also saw inflation concerns, dropping slightly. People often ask us about commodities and say, in times of global volatility, why aren't we holding more gold? Interestingly, commodities were the worst performing asset class in the month, with the Bloomberg Commodities Index falling by 0.6% and gold fell by 0.8%. And that's because there was an improved appetite for people to invest, and there was a move away from those defensive assets such as gold, oil, and commodities in general. So in general, when we've been talking to clients who say, commodities have done well, gold have done well in that time of volatility, for us, we're not looking just at the short term, we're looking at a long-term investment approach so people can have pensions that are driving those returns and investments that are driving those returns, which is why a balanced global approach is what we like to take for clients. So May was characteristic of that rotation back into the high-risk assets, as we've talked about. So equities were doing particularly well, and as I mentioned there, the commodities and the lower risk assets, such as bonds, were rolling back slightly. The easing of these trade tensions reduced the ideas of recession and the fear of what could happen there, and that helped markets to rebound, as we've seen. However, inflation is still elevated, and we're still seeing that as a finely balanced problem for global countries and economies to try and work through. In general, as we've seen in the UK, the Bank of England are trying to bring that base rate down to try and get back to that target. But equally, you wanting to try and manage inflation, and particularly in the US, they're looking at inflation and jobs data to try and make sure that they're keeping the country and the economy going as best they can. So in this environment, we continue to say to clients, it's all about the well-diverse portfolio. It's all about not having your eggs in one basket. When we look at that Caterpillar share price earlier, that's one company. When we're looking at portfolios, we're looking at 10,000 holdings for individuals. So you're not looking at that one company that's going to dramatically impact your portfolio. We're looking at the balance, the diversification. So we've got a bit more of a stabilizer approach to provide those steadier returns for clients over the long term. So yeah, diversification is key, and it's all about looking at regions, asset classes, and seeing how they can behave slightly different and be differently, negatively correlated, so that if one asset class is going up, another one is almost acting potentially in the opposite way to protect, so that things aren't all falling. So when we look under the bonnet of asset classes in 2025, it's an interesting patchwork quilt. And as you can see here, as we've talked about previously, it's not always the same asset class that's driving those returns. When we look at 2023 and 2024, it was growth stocks that were at the top. And then when we look at 2025 year to date so far, growth stocks are towards the bottom of this chart. But interestingly, when we look at the month, so the May figures, the growth stocks are at the top again there. And as I mentioned before, commodities are at the bottom of that month figure. So the patchwork quilt here really shows why we don't want to have all our eggs in one basket and why diversity is key for long-term portfolio growth. When we look at the stock market specifically, as we've already talked about, the S&P has had a particularly good month, but year to date, it's one of the poorest performing indices. So again, for us, we know the US is a driver of global returns over the long term. When we look at 2019, 2021, and 2024 here, they've been, some of the key market performances come from the US, but we don't want to be overly focused to one indices, so it's all about having the balance. I hope you found this interesting. As always, if you've got any specific questions that you'd like us to cover, please get in touch and we'll endeavour to do that. And we look forward to providing you with more market updates to come. We've also been filming things like podcasts to talk about other interesting areas like pensions, tax-free cash, so please check those out on our YouTube channel.